Stock markets are notorious for being highly sensitive to several factors. Some of those factors include policy announcements, interest rates, exchange rates, and oil and gas prices. Financial advisor Ernie Burns from Burns Financial joins us to explain. Thanks for being here.
Thank you.
All right, so let's jump right into this. We saw Iran firing missiles into Israel. I've seen lots of articles already online this morning saying that this could impact oil and gas prices. How so?
It will, because Israel now has fought a war for over a year now. This war has Yemen and Lebanon in it, and now Iran as of yesterday. So this has brought out more and more of the region and is spread out, so therefore it's going to affect oil prices. The good thing is there's a huge supply of it right now, but with China getting involved into it, with the oil industry now, and what the demand is, it's going to be increasing prices.
Yeah, let's talk about that. Could this disrupt supplies?
Not a lot. Not a lot, because of the factors that U.S. is so strongly based with oil now, and the way that it's being increased throughout the U.S. the last 8 years. I don't think the oil prices here will be affected as greatly as fast. Now, if this war goes on and brings other countries into it, Saudi Arabia and others, then there's an issue there.
Is that what's driving the price surge?
Yes, because of the tensions in the Middle East, definitely so, and it's spreading out. With Iran joining in, this could get really intensify overall.
Let's talk about the market. Is it becoming desensitized to Middle East conflict?
It has, because of the Middle East. This issue's been happening over a year now with Israel and Hezbollah. So the markets tend to say, well, it's going to balance out. It's not really affecting the oil industry right now. However, like I said, as it's spreading out across the region of the Middle East, eventually it's going to affect it more and more.
You mentioned China just moments ago. What is China's role in all of this?
China last week decided, the government decided they're going to lower interest rates on mortgage rates overall, which is huge because China built entire cities with no one living in them, expecting expansion overall. And there's huge industries in the real estate market in China that invested billions of dollars, and they're paying the mortgage rates on this. They're paying the interest, and they don't have anyone living in those houses. So by the government stepping in and lower rates has helped them extend those issues out.
Interesting. I know we've been seeing port workers, dock workers across the Gulf Coast and East Coast picketing. Day 2 of that. This might not affect the oil and gas market, but it is going to affect the market to some degree.
Yes, it will, and the supply chain industry is the huge issue. Everybody remembers 2020. So what we see now, we could see now, if they don't solve this issue in the near future, supply chain shortages are going to occur again. Not to the extent it was in 2020, but it is going to limit the supply chains across the U.S.
Okay, so we shouldn't panic.
No, but if this goes on too long, and what the head union person is asking for is extreme demand of 77% more of an increase in pay over 4 years. I don't think they're looking eye to eye for a while. That's the issue.
All right, Ernie Burns, thank you so much for being here. Good advice.
Thank you.